What's up everybody, Genix Dividend Investor here. In this video I'll answer the question of whether now is the right time to invest in good dividend stocks. Now I get why many people are uneasy right now because there's a lot of uncertainty and it's not just about what the stock market's doing week to week. I mean, you hear questions and concerns about the economy, government debt, politics, currencies, and where all this could be realistically headed over the next decade. You've probably seen Ray Dalio talk about long-term cycles and how the United States, while still incredibly strong, appears to be experiencing some of the same late-cycle pressures that other major powers have faced historically, particularly around rising debt, widening wealth gaps, and growing internal and external tensions. At the same time, there's more discussion around the US dollar losing purchasing power, whether paper assets are really the right place to be, and whether hard assets like gold or real estate make more sense if we're headed into rougher waters. For me, I look at high-quality dividend stocks as a way to own productive assets. You're owning businesses with real products and the pricing power to keep up as the dollar loses value. Naturally, if the entire financial system stopped functioning, no paper asset would be the place to be. But whether you agree with all that or not, the broader takeaway is pretty simple. The overall vibe feels more cautious. This caution isn't just a feeling because it's actually showing up in the data. There's a record amount of money sitting in money market funds right now. That big money is waiting for a reason to come back into the market, and historically they look for the durability of strong companies, which dividend-paying companies often are. And when markets start to feel more uncertain like this, dividend stocks tend to get a lot more attention from investors. I mean, they pay real cash, they often reward patience, and for a lot of people they end up becoming the foundation of long-term financial independence. But whether dividend stocks actually make sense right now depends on understanding what dividends really are, and more importantly, when they tend to work best. So think of it like owning a donut shop. Every month the shop makes a profit, and as the owner you basically have two smart options for what to do with that money. You can take some of that cash out and use it, or you can leave it in the business to open new locations, upgrade equipment, or spend on advertising to grow the business. A dividend is just the public market version of taking some cash out of the business. Nothing magical happened, and no new value was created out of thin air. You just converted part of what you already own from business value into usable cash in your pocket. But a key aspect of dividend stocks that I love and that needs to be understood is that you get paid a portion of the profits without losing any of your ownership in the company. In non-dividend stocks, if you need cash, you're forced to sell shares and lose a piece of your ownership every time you want to eat. With dividends, you keep the whole goose and just collect the eggs. Anyway, dividends usually start showing up later in a company's life cycle. When a business is young and growing fast, reinvesting every dollar often makes the most sense because the returns on that reinvestment tends to be very high. But as companies get bigger, growth doesn't disappear, it just stops absorbing all of that cash the business generates. That's even true for massive growth companies. I mean, Microsoft, Google, and Meta didn't start paying dividends because they were suddenly running out of ideas or stopped growing. They started paying dividends because they make so much money that even after funding AI, cloud, research and development, and acquisitions, there's still cash left over with nowhere equally productive to put it. At that point, paying owners isn't a weakness at all. It's simply good capital discipline. So dividends aren't about companies giving up on growth. They're about companies being efficient with excess cash. And that brings us to the real question. In today's market, is it better to take some cash out of the donut shop or leave every dollar inside the business and let it keep compounding? To answer that, we need to talk about risk on and risk off. Right now, the market is still technically risk on, at least by most standard definitions. Stocks are broadly up, volatility is fairly contained, and money's still flowing into equities. Markets don't usually flip early, they flip late. We're seeing this right now with what people are calling the SaaS apocalypse. Headlines about how the new Anthropic cloud agents can bypass traditional software entirely are causing a panic. Investors are realizing that the old software as a service model is under fire if an AI can just do the work for you. And that's why they're rotating into real gorillas with moats that a chatbot can't easily touch. But this doesn't really feel like early cycle risk on anymore. No, it feels more like late risk on. Late risk on is when prices are still strong, but the foundation underneath starts to feel a little shakier. Growth slows, financial conditions tighten, confidence becomes more fragile, and things still work, just not as easily as they did before. So let's go back to the donut shop again. Business is good, you're profitable, customers are steady, and you're still opening new locations. But at the same time, the economy feels less predictable, costs move around more, and the margin for error starts to shrink. Expansion still works, but you're more careful about it. In that situation, you might still grow, but you'd probably think twice before pouring every extra dollar back into expansion without keeping some flexibility. You might decide to take some cash out, not out of fear, but to stay adaptable. That's basically what tends to happen late in a market cycle. This is when a lot of experienced investors start getting more defensive, often quietly. They're not dumping everything usually, and they're not trying to call a top. They stay invested, but they shift posture by trimming higher risk exposure, leaning towards strong balance sheets and reliable cash flow, raising some cash, and shortening their time horizons a bit. They're still participating in the market. They just know where the exits are. Markets often top on good enough news rather than outright bad news. Things don't need to break for behavior to change, they just need to stop getting better. That's why late bull markets can feel so confusing, because prices keep going up while confidence quietly goes down. A really useful way to think about the environment right now is this. The regime is still risk on, but the posture is getting more defensive. Dividend stocks tend to fit really well in that kind of environment. Not because they eliminate risk or guarantee safety, but because they can convert part of your return from price movement into actual cash flow, and that distinction matters. Dividends don't automatically protect you from owning bad businesses, they don't override valuation risk, and they don't replace growth. What they do give you is flexibility, because cash can be used, reinvested, or held without forcing you to sell shares at the wrong time. Now I want to make this concrete because this isn't theoretical at all for me. I literally just got dividend increases from a couple of my core holdings. Pepsi raised its dividend by about 4%, and Chevron raised theirs by about 4.1%. Those increases are actually lower than the long-term averages, which often tells you the businesses are seeing, or at least expecting, a bit more turbulence ahead. So who knows what the future will bring? But I do believe enough in the companies I own and in the whole dividend investing process to trust that those payments will keep coming in. Dividend income is how I pay my mortgage, buy groceries, pay for medical insurance, and cover our day-to-day living expenses. If I'm wrong and dividends don't get paid out or get meaningfully cut, then my fallback plan is pretty straightforward. I'd have to sell shares. Sure, I've got some cash savings I could use for a while, but the reality is that I literally rely on dividends to pay our bills. I do get a small amount of income from my social media, but it's surprisingly small relative to the time involved. But I love doing it, so I'm cool with all that. Other than fun and exercising my mind in retirement, along with wanting to help influence people to invest, I'm also doing social media to show my kids how they can start their own online businesses. And I'm happy to report that my son just started posting on social media, but don't ask me what he's doing, as he shows his face and I don't want our finances tied to who we are. I mean, there's lots of crazies out there, so I'm not into flashing our wealth. Anyway, if we ever got hit with a true black swan where the entire stock market stopped functioning or stopped paying altogether, we'd probably be dealing with problems so large that paying my mortgage wouldn't exactly be top of mind anymore. So a takeaway is that I believe enough in my dividend income that I quit my job years ago and rely on those dividends to pay the bills. These days, some of our dividend income goes towards helping relatives who need it, and if money ever became an issue, that's something I could always scale back. In a way, I'm kind of doing what my companies are doing. I mean, when I see those 4% raises from Pepsi or Chevron, like I just got, I don't see material weakness. I see capital discipline. And just like I keep my spending flexible so I can scale back if things get rocky, these companies are doing the same. They're not overextending themselves just to look flashy. They're keeping a cash cushion to stay adaptable in an unpredictable economy. I'm betting on the businesses that are actually feeding and fueling the economy today, and I want them to be just as disciplined with their cash as I am with mine. So when I talk about dividends, I'm not talking about theory or backtests. I'm talking about something that actively funds my family's life right now. Which brings us back to the original question. How do you actually decide if now's the right time to invest in good dividend stocks? Well, let's break that answer into 4 parts. First, are you ready to invest? Before dividends, before stocks, before the market, this comes first because having an emergency fund, manageable debt, and money you can commit long-term matters more than yield. Dividend stocks tend to work best when your foundation's solid. Second, do you understand the trade-offs between individual stocks and broad market ETFs? I mean, individual dividend stocks give you more control and customization, but they also come with concentration risk and the need for ongoing monitoring. Broad market ETFs tend to spread that risk out and simplify things, but you give up some control. Both approaches can work as long as you understand which one you're choosing and why and what the various trade-offs are. Third, does the current market environment support a more defensive tilt? Right now we're still risk on, but it looks like late risk on, which is when cash flow, balance sheet strength, and business durability start to matter more. That's where dividend companies often fit naturally, without fully stepping out of the market. And remember, there are growth companies that pay dividends, so the spectrum of what a dividend company is quite broad. I mean, you've got the classic gorillas like Pepsi, but you've also got tech giants that are still innovating while paying you to wait. Fourth, do dividends actually fit your portfolio strategy? I mean, if you need income now, dividends can be incredibly powerful. But if you don't need the cash today, you've got to realize you're making a deliberate trade-off. You're giving yourself the option of cash in your pocket, but you can also choose to reinvest that money to grow your percentage of ownership in the company. Just keep in mind that even if you reinvest every cent, you might still be dealing with tax implications depending on what kind of account you're using. So it's not right or wrong, it's just about whether you want that flexibility now or if you'd rather the company just keep it and grow the shop for you. And speaking of your account type, remember that retirement accounts tend to allow dividends to compound cleanly, while in taxable accounts the trade-offs are different. So the answer to whether now is the right time to invest in good dividend stocks depends on all four: your financial readiness, your understanding of risk and structure, the market's shift toward a more defensive posture, and how dividends fit into your long-term plan. Because if you don't need the cash, and the donut shop can still earn high returns reinvesting it, taking money out too early can quietly cost you a lot over time. But if you do decide that a company is worth owning for the long haul, you have to be prepared for the times when the market hates it. That's why a key facet of buy and hold investing is to stay strong when an otherwise quality company loses favor. Like, look at J&J. It's an amazing company with great financial trends, but people were understandably worried about all the litigation against it, which is still going on. I watched firsthand how as J&J struggled, many in the dividend investing community sold and the stock fell. I don't fault anyone for selling for whatever reasons they have, because selling could be the right move for you. But my point is that quality assets almost always recover, and in the last year we see that J&J returned 56% as compared to 17% for the SP 500. It's kind of a similar story with SCHD. It underperformed last year because its rule-based approach left it underweight the AI-led tech rally and overweight slower-moving sectors like energy and consumer staples. That drag was compounded by the fact that higher interest rates made sitting in cash or T-bills look more attractive to investors than dividend stocks for a while. Back then, some people were calling it trash and saying the strategy was broken, but look how the backdrop's changing. As institutional money's grown more valuation sensitive, it started rotating back toward durable earnings and defensive cash flows. In just the last month, SCHD's gone up about 11%, while the SP 500 has been basically flat. The fact is that long-term quality eventually wins, and you just have to resist the urge to panic when the tech sector is the only thing getting headlines. That doesn't mean SCHD will keep going up, nor does it mean anything other than I recurringly see tickers go out of favor, sometimes for legitimate short-term reasons, but long-term quality always wins. And the more important part is that I'm just saying to be careful not to overtly react to news, YouTube videos, whatever, and look at what your ticker's actually doing, whether it's an ETF or a single company. So again, is now the right time to invest in dividend stocks? And I believe the answer is yes. For me, it's almost always the right time to invest, as long as you're focused on quality and staying consistent with your process. I currently reinvest 20% of my ETF payouts back into themselves, and in fact I did that today with my JEPQ payout. As you can see here, JEPQ paid me $1,264 today in my retirement account, and then I took about $253 of it and bought more shares. So 80% of its payout I withdraw early and pay taxes on, and then use that to pay bills, and 20% I'm reinvesting to slowly grow my share count. Of course, quality is often in the mind of the beholder, and I could tell you a bunch of reasons why JEPQ isn't quality, and why J&J isn't either, but I like both of them. And speaking about JEPQ and CC income ETFs in general, I have an interesting question I'll pose to the community. If something crazy happens and the stock market crashes 50% and then goes sideways for a year, then how much, on average, would you guesstimate that the average covered call ETF's payouts would decline by, if any? Before you answer, listen to this. A few days ago, I tweeted about GPIQ's latest payout, which is another CC income ETF I own, and someone named Joe Henry said he had been looking at CC ETFs and asked how I thought they'd perform in a market downturn. Then another person tweeted that if the market crashes 20%, then CC ETF income will likely fall by the same percentage, if not more. So like my 1264 payout would instead be 1011. And interestingly, I've also been chatting with someone on my Discord, and I'll keep his name private as it was a PM, but he said that what he loves about covered call ETFs like JEPQ and DIVVY is that they actually generate more income because options premium will be greater, even though you'd see a decline in value just like SPY, but they likely won't go down as much. Now, I agree that the initial spike in volatility should help premiums, but I think once things settle down and if the market goes sideways, then I think the lower base will also push towards lower payouts. Basically, if the share price drops 50%, the base you're writing calls against is 50% smaller. Even if volatility is high, 1% of a $50 stock is half the cash of 1% of a $100 stock. That's kind of why I expect payouts to drop significantly in a crash, even for the best funds. But let's look at a recent example which highlights what I'm talking about. Look at the 2020 pandemic. The SP 500 lost about 34% from its peak, but it recovered quickly. Now let's look at what DIVVY did. It dropped about 30%, slightly less than the SP 500, which is great. But when we look at its payouts, they dropped from 13.89 cents per share in January to 10.95 cents in March. That's about a 20% drop. So even DIVVY, which I consider S tier when it comes to covered call income ETFs, saw its payout materially drop like its ticker did. However, this dip proved temporary, with payouts rebounding to 12.46 cents in April and climbing above pre-crash levels to 14.06 cents by August, fueled by the spike in option premiums during the heightened volatility. And here's an interesting note about DIVO and EDIP, the Enhanced Dividend Income Portfolio by Amplify. EDIP was actually the private strategy that DIVO was eventually based on. If anyone can share how EDIP did, both in terms of price and payouts over time, I'd be interested in seeing that. Anyway, with all that context shared, I ask you to leave me your thoughts. Do you think a 50% market drop and then going sideways would cut these decent CC ETF payouts by 50%? More? Less? My gut tells me we would see an income drop of 25% to 50% in a major downturn, but tell me what you think. I truly hope I'm wrong and that in a crash situation where the market settles lower, these income ETFs will keep paying out the same as they did before. Time will tell, and I'm just someone who dabbled in options long ago, and I'm really just guesstimating how this might play out. Regardless, I know that even safe dividends aren't 100% bulletproof in a total black swan event, but as a retiree, I'm playing for posture and probability, not performance guarantees. That's part of the reason I don't just yield chase by putting 100% of my portfolio in these covered call funds. I make sure to balance these ETFs with my gorilla stocks like AbbVie, Southern Company, Johnson & Johnson, and Procter & Gamble, to name a few. And while the premiums on a CC ETF might swing wildly based on market volatility and share price, companies like J&J or PG have a history of prioritizing their payouts even when the world is leaning over a ledge. They provide a solid floor that keeps my total income from collapsing, even if my covered call payouts take a massive hit. Regardless of all that, there's one thing I do know you should do right now, and that's to be extra kind to those around you, as your act will probably mean a lot more than you could ever realize. And with that, I shamelessly ask you to show me some kindness and please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to do some shoutouts, and I'll start with Overlord, who just signed back up as a Patreon aristocrat. Next, I'd like to show my gratitude to subscribers who left me kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Greg, Not Today Satan, Eli, Wak Hawaii, Tony Kim CRE, 5 Dumars, and then multiple from Jack Lanzalotti, multiple from Shannon Cargo, multiple from Ken's, and multiple from Investing with Adam K. Thanks folks, I really appreciate it. Next, I'd like to pitch my Seeking Alpha affiliate link, which often has benefits when new users sign up. I'd also like to pitch my Fast Graphs affiliate link, along with my coupon code in the description of this video, as using both will allow new subscribers to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, and/or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 87 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.